Imagine two people. Both start investing at age 25. Both put in $500 every month. One builds a portfolio of dividend-paying companies. The other buys a simple S&P 500 index fund and never looks back. Fast forward 30 years. The dividend investor is sitting on roughly $850,000, collecting about $34,000 a year in passive income without selling a single share. The index fund investor? Over $1 million. But here's the twist. The dividend investor sleeps better at night, never panicked during a crash, never sold at the wrong time, and that difference cost them everything they gained on paper. So which strategy is actually better? That's what we're answering today. If you're new here, my name is Ellis. I simplify investing so anyone can understand it. If building long-term wealth sounds interesting, consider subscribing. Now let's begin. What is dividend investing? Imagine owning a rental property. Every month, your tenant pays you rent, even if you don't sell the house. Dividend investing works almost the same way. Instead of buying property, you buy shares of companies. Some companies share part of their profits directly with shareholders. Those payments are called dividends. For example, if you own shares of Coca-Cola, Johnson & Johnson, Pepsi, or Procter & Gamble, you receive dividend payments every quarter, whether the stock price goes up or not. That's why dividend investors love this strategy. Their money literally pays them to hold it. What is an index fund? Now compare that with an index fund. Instead of picking individual companies, you buy hundreds at once. The most famous example is the S&P 500. One investment. 500 of America's biggest businesses. Apple, Microsoft, Amazon, Nvidia, Meta, Visa, Costco, and hundreds more. You don't research every company. You simply own the entire market. If America grows, your investment grows too. The real difference. Here's what most people miss. Dividend investing is not the opposite of index investing. It's a different goal. Dividend investors want income now. Index investors want maximum growth over time. Neither is wrong. They solve different problems. Returns. The numbers you need to see. Let's go back to those two investors, both investing $500 a month for 30 years. A broad S&P 500 index fund has returned roughly 10% annually over long periods. $500 a month at 10% for 30 years grows to approximately $1.13 million. A typical dividend-focused portfolio might average closer to 7 to 8% annually. Why lower? Because the companies paying the highest dividends are usually mature businesses, stable, steady, but not fast-growing. Nvidia doesn't pay much of a dividend. Amazon paid none for years. Meta reinvested profits back into the business. Those decisions pushed their stock prices far higher than any dividend check could, at 7.5% average returns. That same $500 a month over 30 years becomes around $680,000, a gap of roughly $450,000. But here's what makes this complicated. The income advantage. That dividend investor with $680,000. If their portfolio yields 4 to 5%, they're collecting between $27,000 and $34,000 per year in passive income. Without selling a single share, the index fund investor has more money. But to create income, they have to sell shares, which means they're spending down their portfolio. For retirees, selling shares during a market crash can be devastating. The dividend investor just keeps collecting their payments. Even when markets drop 40%, the dividends often keep coming. That psychological safety is worth something very real. The dividend ETF middle ground. Here's what most YouTube videos skip entirely. You don't have to pick individual dividend stocks. Dividend ETFs exist specifically for this. Funds like SCHD or VYM give you exposure to dozens of high-quality dividend companies in a single purchase. Lower risk than picking stocks yourself, lower cost than actively managed funds, and you still get regular income. This is the option most beginners never hear about. Diversification. If you build a dividend portfolio of 20 individual companies, compare that to an S&P 500 fund with 500. Technology, healthcare, energy, banks, industrials, utilities. If one company fails, it barely moves the needle. That's why index funds are one of the most reliable long-term strategies ever tested. Effort required. Dividend investing requires real work. You need to analyze companies, monitor payout ratios, watch earnings reports, understand when a dividend cut might be coming. And cuts do happen. Companies like GE, AT&T, and Ford have all slashed their dividends in recent years. Index funds require almost nothing. Buy consistently, ignore the noise, repeat for decades. Taxes. The part people always skip. This matters more than most people realize. In the US, qualified dividends are taxed at 0%, 15%, or 20%, depending on your income level. And you owe that tax every year, whether you spend the dividends or reinvest them. Index funds tend to be more tax efficient. Most of your return comes from price appreciation, which you only pay tax on when you sell. That delay compounds over decades. If you're investing in a tax-advantaged account like a Roth IRA or 401k, this difference matters less. But in a regular brokerage account, taxes can quietly cost dividend investors a meaningful amount each year. Always understand your country's tax rules before choosing either strategy. Psychology. This is where dividend investing quietly wins for a lot of people. During a market crash, watching your portfolio drop 30 or 40% is terrifying. Many investors panic and sell at exactly the wrong moment, locking in permanent losses. But dividend investors have something index investors don't: cash coming in every quarter, that income reminder. My portfolio just paid me $600 even though prices dropped. Keeps people invested, and staying invested is the single most important thing in long-term investing. An index fund that earns 10% but causes you to panic and sell will always lose to a dividend portfolio that earns 7.5% that you actually hold for 30 years. Can you combine both? You don't have to choose. Many experienced investors do something like this: 60 to 70% in a low-cost S&P 500 index fund, 20 to 25% in dividend growth ETFs like SCHD, 10% in international or bond funds for balance. You get diversification, you get long-term growth, and you get real passive income along the way. Who should choose dividend investing? Dividend investing may suit you if you're approaching retirement and want income without selling shares. You enjoy researching companies and following businesses. You need psychological reassurance during volatile markets. You're comfortable with the extra tax and research work. Who should choose index funds? Index funds may suit you if you're a beginner and want the simplest possible strategy. You have decades before you need income. You want maximum diversification with minimal effort. You prefer the highest historical long-term returns. Final verdict. So who won? On pure numbers, the index fund investor came out ahead by a wide margin, but the dividend investor who actually stayed the course beat the index fund investor who panicked and sold every time. That's the real lesson. The best strategy is the one you can stick with through a 40% market crash, through a recession, through years of slow, boring growth, and still keep going. For most beginners, start with index funds. Keep it simple. Build the habit. Once you have experience and confidence, add dividend stocks or dividend ETFs if income matters to you. Because in investing, time in the market always beats timing the market, and consistency always beats complexity. If this helped you understand the real difference between dividend investing and index funds, hit the like button. Subscribe for more videos like this,